One of the world's largest transporters, FedEx, just reported Q2 numbers this week, and the street gave us a 7% increase in the stock. And altogether, since they started their decline back in 2021, the business is now down 43%. This means we are now sitting at a market cap of $44 billion, a PE of 13, and a dividend yield of 2.6%. So, with FedEx being a distribution conglomerate, a business with over 5 million package deliveries per day, is this the perfect chance to pick up shares at a steep discount, or is this stock heading lower for longer? I mean, especially if you're looking for some exposure to a recession-proof business, stay tuned because we'll answer all those questions and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day and happy holidays. Today, we'll be starting with the full analysis into FedEx's business, the top line balance sheet, cash flows, all of that, so that by the end of the video, we can use our intrinsic value calculator to see the buying opportunities with FedEx, at least in the near future. And if you enjoy this type of content, make sure to subscribe as we post on here regularly, analyzing the businesses that you are most interested in. So also make sure to comment down below the stocks you want to see us analyze next. And if you do enjoy the video, also make sure to leave a like. And with all that out of the way, let's jump into the analysis. All right, and starting with FedEx's Q2 for fiscal year 2023, what exactly happened? Well, let's look at their business overview. As you can see here, revenues increased just about 3% year over year, which means they're relatively flat year over year. And they're saying this is a direct result of their pressures from softer global demand. That being said, if you take a look just right down here, operating income is actually up 30% year over year. Why is that? Well, it's because they're taking cost actions to improve their service levels. We'll talk a little bit more about that in just a second. If we take a look at the segment revenue performance, FedEx Express, their main revenue segment, down 6%. However, FedEx Ground growing, relatively flat year over year, just 2% increase. FedEx Freight is up 8%. So that's at least a slight increase on last year's results. And again, they're saying this is a direct result of the volume weakness that they've seen. Of course, it was only last year when people were still locked in their homes, malls and stores were still closed down and everything. So you were almost forced to buy things online. And so FedEx definitely had a net benefit from that. Now we're seeing people are going out to the stores, out to the malls. You've probably done it yourself now rather than just ordering stuff online. And so this is a direct negative impact to FedEx and their business. And we can actually see their volume trends over the last few months. You can see across the board, negative results, and they're actually growing and accelerating negatively. It's not good for this business right now. And if we look at this chart from Main Street Financial Data, our video sponsor today, we can also see decline in their average daily packages. As you can see over the past few quarters, this has steadily been declining as well, which really goes to show the weakness behind the lack of volume here and how it has impacted revenues over the last few quarters after some consistent and decent growth from just 2 years ago. All right, and if we look at this chart from Main Street Financial Data, their average revenue per package has also been on the decline as well, at least in their express segment, which again is their main revenue segment. So not only are volumes decreasing, but they can't even charge as much as they used to. Again, we're going to see impacts to that business there. Again, if you want access to amazing charts like this that can help you break down key fundamental data, you have to check out the first link in the description, Main Street Financial Data. That being said, FedEx definitely recognizes that they do have some challenges here and that they obviously need to correct them in order for this business to function properly. And well, they're obviously going to accelerate their cost actions, improve service and customer experience. But what I really want you to focus in on here is that they're moving with urgency on their drive initiatives. Now, what is their drive initiatives? Well, it's FedEx's plan to reduce more than $4 billion in structural costs by fiscal year 2025 in an attempt to not only reduce their costs, but also increase the profits and just ultimately improve this business. Obviously, when we had the pandemic, everyone was forced to order online. So even though costs were able to increase at that time, revenues definitely skyrocketed. Now we're in the opposing situation where expenses have been increasing while revenues have been declining. So they're recognizing that in advance and they know they're going to try to cut these costs across their main revenue segments, and we will see how that plays out for them. As you can see, so far for this fiscal year, they've been able to save about $1.2 billion in costs. So their plan is working thus far, but we have to see how it plays out over the next few years because it really will benefit the business if they are able to do so. And again, you're going to see $23 billion in revenues for this quarter, down from the $23.5 billion last year that we had. But when you look at their operating expenses, after you add all of them in, they have quite a few. They have $22 billion here and actually just a little bit less. Let's just call it $21.5 billion in operating expenses. So again, we're seeing that benefit from cost savings. So despite revenues decreasing, operating expenses have also been decreasing. And that's why we're left with $1.1 billion in operating income for this quarter. Now, this is a business that has decent gross profit margins, up in that 68 percentile range. However, when we get down to our operating margin, it's pretty thin at just 6%. And it's been relatively relatively stable there even throughout the pandemic. So at least from an operating margin perspective, not looking so good. And that is why they're going to try to, cut some costs to at least improve that number just a little bit. It'll definitely benefit the business on the back end. When we look at the balance sheet overview, assets, not a problem, quite a few assets. Liabilities, there actually is a decent amount of liabilities on this balance sheet, but nothing to concern investors at this point, as they still have equity that is growing within this business. Now, when we get down to our statement of cash flows down here, we produce $3.1 billion from operating this business. But when it comes to their capex, they have $3.1 billion in capital spending. So right away, all the cash that they produce from operating the business has gone immediately out to their capex figures and maintaining the business. And so that doesn't really leave us with much to do in terms of rewarding shareholders. However, that being said, they did actually still go ahead and repurchase shares and also pay out their dividend. Of course, they'll be using cash and debt to fund these operations here, but they are planning on reducing that capital spend here. They're saying they should come in at around that 6 billion figure by the end of the year. So far, they spent that $3.1 billion on capex. So, that's a down about $1 billion from last year, and they're going to plan to further reduce that capital spend figure by the year 2025. So again, we'll see how this impacts the business. They should be able to produce higher levels of free cash flow, ultimately leading to higher shareholder returns in the future. And if we look at their fiscal 2023 outlook, they're saying that they're going to produce in and around that $13 to $14 earnings per share price figure. And that does equate to about the levels that they have been producing over the last 2 years, in and around that $6 to $6.5 billion operating income price range. So if we add that into our calculator, if we require a 10% return, they do currently pay a dividend. And if we expect that this business can grow at about 4% for the next 5 years on that lower volume, but also on that cost reduction, and then for the 5 to 10 years after that, they're able to, really benefit from the cost reductions, grow at, let's just call it 5 to 6%, on a 12 PE, like they're kind of trading at right now, the stock should be worth actually about $400 per share, more than a double from where they are currently. Now, in the most optimal situation here, let's assume they can grow at 7% for the next 5 years. That drops down to about 6% for the 5 to 10 years after that. On an 18 PE, the stock would be worth even more than that. We're talking about in that mid $500 price range on the backs of an economic rebound in the economy, where more people are actually spending to have goods and services delivered. We see a great increase in the volume and demand. Cost reductions also improve the business. So that's what we could see in that situation there. Now, in the very worst case scenario, let's say they actually continue to decline for the next 5 years, at about 1% each year, then we can only grow at about 2% for the 5 to 10 years after that. On an 8 PE, the stock would still be worth $246 per share with the business and the infrastructure that they already have in place, which really goes to show the strength behind said business. And it's no surprise, as they are a distribution conglomerate. Now, that is in an optimal situation where they're able to still produce the $6.5 to $6 billion in operating income like they mentioned. If that drops down somehow to, let's just call it $4.5 billion in operating income, we can really see the difference in the valuation here. That would drop down to 276 in a normal case, and it would actually make them about fairly valued for where they're trading at right now. Again, we have to look at our metrics down here. They're trading at a relatively cheap price to earnings ratio, price to sales, and price to book ratio. Price to free cash flows could be a little bit better, but still, this looks relatively cheap all around for such a huge conglomerate. And if we take a look at the historical chart, we've been up in that $300 price range before, and that was without the cost reductions that they're planning on achieving over the next few years. So imagine with the cost reductions, with the improved business, with higher demand, with the resurgence in the economy, more people ordering shipments of goods and such, we can definitely see an increase in the stock. And if you did purchase the stock right now, you'd also be receiving a dividend as well. So definitely something to think about here. We can see this business has been compounding relatively well since its inception. So I'll leave you to make an investment decision on that. That's been the analysis for today's video. If you've enjoyed it, please like, subscribe, comment your thoughts on this business down below, and also comment on the stocks you want to see next. Again, make sure to check out Main Street Financial Data for those key investment graphics. And with all that, I'll catch you on the next one.